Welcome to the deep dive. We're tackling a big one today, unlocking the fundamentals of mortgages for homeownership.
Yeah, it's a huge financial step.
It really is.
Yeah.
And feeling truly in the know is, well, it's the very first brick in that foundation, isn't it?
Absolutely. Whether you're picturing your future on a welcome mat or, just thinking about moving, the mortgage landscape can seem like a maze.
Definitely.
So our goal today is really to cut through some of that complexity, highlight the core concepts so you can navigate this with more clarity.
And to really show why this understanding matters so much, think about, say, the Johnson family.
Okay.
They were excited, buzzing about their first home, but all the talk of interest rates, loan terms, it felt like a foreign language.
I hear that a lot. It can be overwhelming.
Totally. But after, digging in and really grasping the difference between fixed rate and adjustable rate mortgages, they went with a 30-year fixed rate.
Okay, the stable option.
Exactly. That consistent monthly payment gave them real peace of mind. They knew their housing costs would fit their long-term financial picture.
That makes sense. It really shows how vital understanding these basics is.
It does. Okay, let's unpack this then. At its heart, what is a mortgage, really?
Well, in its simplest form, a mortgage is just a loan specifically for buying real estate.
Property.
Okay, a loan for property.
Right. And what makes it different is that the property itself, the house, acts as security for that loan.
Ah, collateral.
Precisely. Think of it like this. You borrow a big sum, and the house is the guarantee for the lender. These loans usually run 15 or more commonly 30 years.
Right, so you're making payments over that whole time.
Month after month, yeah.
And those monthly payments, they aren't just paying back the loan amount itself, are they? There's more packed in there.
You got it. Most mortgage payments bundle together what we call PITI.
PITI.
It's an acronym. P is for principal. That's the initial amount you borrowed, the core of the loan.
Then A is interest. Basically the cost of borrowing that money.
The lender's fee, essentially.
Kind of, yeah. Then you have T, property taxes, your contribution to local services, schools, roads.
Right. Paid annually, but often escrowed monthly.
Exactly.
Yeah.
And the final I is homeowners insurance. Protects against damage, fire, that sort of thing.
So PITI, principal, interest, taxes, insurance, all in one monthly payment.
That's usually how it works, yeah.
Yeah.
It makes it clear that owning a home involves more than just the loan repayment.
Okay, that breakdown helps. Now, when you start looking into mortgages, you hit this alphabet soup of terms. Fixed rate, ARM, FHA, VA. Can you give us the rundown on the main types?
Sure thing. So the most common one is probably the fixed rate mortgage.
Like the Johnsons got.
Exactly.
Yeah.
The interest rate stays the same for the entire loan term, predictable payments.
Okay.
Then you have adjustable rate mortgages, ARMs.
ARMs.
With these, the rate is fixed for an initial period, maybe 3, 5, 7 years, but then it can change, go up or down based on market conditions.
So less predictable long term.
Potentially, yes. Beyond those basic structures, there are different loan categories. FHA loans, backed by the government.
Federal Housing Administration.
Right. They often let you make a smaller down payment. Good for first-time buyers, sometimes.
Makes sense.
Then there are VA loans, specifically for veterans and active military. Often really great terms, sometimes no down payment at all.
That's a fantastic benefit.
It really is.
Yeah.
And finally, conventional loans are just those not backed by a government agency. Usually require a larger down payment, maybe better credit.
So quite a few options. Fixed, adjustable, FHA, VA, conventional. How does someone even start to figure out which one fits them?
Ah, that's the key question, isn't it? It really boils down to your individual situation and, importantly, your long-term goals.
Okay.
If you value stability, know you'll be in the home for, say, 10, 20, 30 years, a fixed-rate mortgage offers that peace of mind.
Like the Johnsons.
Exactly. But if you think you might move in maybe 5 or 7 years, an ARM might offer a lower initial interest rate, potentially saving you money in the short term, but it's a bit of a gamble on where rates will go.
Right. You're betting they won't shoot up right when your rate starts adjusting.
Pretty much. So understanding your timeline, how long you plan to stay, is really crucial for this decision.
Okay, that makes sense. Timeline is key. Now let's shift gears slightly. We hear people talk about using their home's value. HELOCs come up. What exactly is a HELOC?
Right. ELOC. Home equity line of credit.
Okay.
It's basically a revolving line of credit, kind of like a credit card, but it uses the equity you've built up in your home as the collateral.
So the part of the home you actually own, not the part the mortgage covers.
Exactly. The difference between the home's value and what you still owe. And a key thing with the ELOCs, the interest rates are typically variable. They can change.
Variable rates again. And why would someone get a EPLOC? What are they used for?
Oh, common uses are things like major home improvements, kitchens, bathrooms, addition,
Renovations, yeah.
or maybe consolidating higher interest debt like credit cards, or even just having a safety net for emergencies.
Because the rate might be lower than, say, a credit card rate.
Often, yes, because it's secured by your home.
Yeah.
That makes it less risky for the lender.
Okay. So how does it work mechanically? Are there phases or periods to be aware of?
Good question. Yes, HELOCs usually have two main phases. First is the draw period.
Draw period.
Yeah,
Yep.
typically lasts around 10 years. During this time, you can borrow money from the line of credit as you need it, up to your limit.
Like using a credit card.
Exactly. And often during this draw period, your required payments might only cover the interest on the amount you've borrowed.
Just the interest. Okay, that sounds low initially.
It can seem low, yeah. But then comes the second phase, the repayment period, often around 20 years.
And then?
Then you have to start paying back the principal plus the interest on whatever you borrowed.
Ah, so the payments jump up.
They can, yes. And remember that a variable interest rate, if rates have gone up, your payment could increase significantly during that repayment period.
That seems like a really important risk to understand. The payment changing.
Absolutely critical. Because remember, your home is the collateral.
Right.
If you can't make those potentially higher payments during the repayment period, you could, in the worst case, face foreclosure and lose your home.
Wow. So a powerful tool, but definitely one to use carefully.
Very carefully. Responsible use is key.
Could you maybe walk us through a quick example, make it a bit more concrete?
Sure. Let's imagine Sarah. She wants to redo her kitchen. Her home is valued at $300,000.
Okay.
She still owes $200,000 on her main mortgage.
So she has $100,000 in equity.
Exactly. The lender might approve her for an ELOC of, say, $80,000.
Yeah.
That's 80% of her equity, which is pretty common.
Got it.
Sarah decides she needs $50,000 for the kitchen renovation, so she draws that amount from her ELOC. During her 10-year draw period, she might just pay interest on that $50,000. But once the repayment period starts, her payments will cover both principal and interest on whatever balance is left.
And that payment could fluctuate if the interest rate changes.
Precisely.
Okay, that example really helps clarify the draw and repayment parts. Let's move to something more serious now. Foreclosure. What is that exactly?
Foreclosure is the legal process a lender uses when a borrower stops making their mortgage payments as agreed.
They can't pay anymore.
Right. And if the situation is resolved, it can ultimately lead to the lender taking possession of the property.
Taking the house back.
Yes. It's obviously a very significant event. Huge financial consequences and, a heavy emotional toll, too.
What kind of financial fallout are we talking about beyond losing the house itself?
Oh, it does serious damage to your credit score. Really severe.
Making it hard to borrow later.
Extremely hard. Getting another mortgage, a car loan, even credit cards becomes much more difficult for years. It can even affect renting an apartment or certain job prospects.
Wow. And the emotional stress.
Immense. Losing your home is a deeply distressing experience.
It sounds awful. Are there ways to prevent it if someone sees they're heading for trouble?
Yes, absolutely. The most important thing is communication. Talk to your lender as soon as you think you might have trouble making payments. Don't wait.
Be proactive.
Yes. Lenders often prefer to find a solution rather than foreclose. They might offer options like loan modification.
What's that involve?
It could mean changing the terms, maybe lowering the interest rate temporarily or permanently, extending the loan term to lower payments, or sometimes even reducing the principal balance owed.
To make the payments manageable again.
Exactly. Refinancing might be another option, though that can be tough if you're already struggling. Understanding your rights as a borrower is also vital.
Rights?
Yes, there are rules about the foreclosure process. And seeking help from a HUD-approved housing counselor is highly recommended.
HUD Housing and Urban Development.
Right. They offer free or low-cost expert advice. They can negotiate with lenders, help you understand options. They're a fantastic resource.
It's good to know help is out there. You mentioned loan modification, helping someone avoid foreclosure. Do you have an example?
Sure. Think about Mark. He lost his job unexpectedly. Suddenly, mortgage payments were impossible.
Oh, no.
He was facing foreclosure, really scared. But he reached out to a housing counselor.
Good move.
Yeah. The counselor helped him talk to his lender, navigate the process. They worked out a loan modification that lowered his payments significantly.
So he could afford them while job hunting.
Exactly. It bought him the time he needed, and he was able to keep his home. It shows that taking action, seeking help can make a huge difference.
That's a really hopeful story. Now, earlier we mentioned collateral, the house securing the loan. Can you explain that connection a bit more?
Sure. So when we talk about collateral in a mortgage, it is the property,
Yeah.
the house itself.
Your physical asset.
Right. The lender gives you this large sum of money, and in return, they have a legal claim on that specific property if you don't hold up your end of the deal making payments.
It's their security.
It's their safety net, exactly. If you default, the collateral gives them the right to go through foreclosure to try and recover their money.
So because the house is their security, what does that mean for the homeowner's responsibilities beyond just making payments?
Well, it means you have a responsibility to maintain the value of that collateral.
Keep the house in good shape.
Yes. That includes having adequate homeowners insurance. Lenders require it.
To cover damage, right?
Right. And general upkeep, you can't let the property fall into disrepair. You also need to pay your property taxes on time.
Because unpaid taxes can lead to a lien.
Exactly. A tax lien, which can take priority even over the mortgage lender's claim in some cases. Lenders don't like that. You also want to be careful about other liens, like from unpaid contractors.
Okay, so maintain it, insure it, pay taxes on it.
And generally, just protect the asset. Keep an eye on its value, too.
It makes sense. You're safeguarding their security, essentially. Okay, let's pivot to some really practical advice. What are some key expert tips for someone going through this mortgage process?
Okay, top tips. First, if you can, save for a larger down payment.
Why is it so helpful?
It lowers your monthly payments, obviously, but it can also help you avoid private mortgage insurance, or PMI, which is an extra cost if you put down less than 20% typically.
Good point. What else?
Get pre-approved for your mortgage before you start seriously house hunting.
Not just pre-qualified, but pre-approved.
Yes, pre-approval is much stronger. It tells you exactly how much you can borrow and makes your offer more attractive to sellers.
Okay, pre-approval first.
Also, really understand all the closing costs. It's not just the down payment. There are lender fees, title insurance, appraisal fees. It adds up.
Factor those in from the start.
Definitely. And related to that, budget for the PITI principal, interest, taxes, and insurance, not just the P&I.
The full monthly housing cost.
Right. And one last thing, build an emergency fund. Specifically for home stuff, repairs happen. Roofs leak, water heaters break.
Having cash set aside avoids a crisis.
Exactly. Provides a crucial safety net.
Those are all super helpful, practical tips. Now let's tackle some common myths. Things people often get wrong about mortgages.
Oh yeah, there are plenty of those. Let's debunk a few.
Okay, myth number 1. You need 20% down to buy a home. True or false?
Mostly false. That's a big one.
Yeah.
While 20% down helps you avoid PMI, tons of loan programs, especially like those FHA loans we mentioned, allow for much lower down payments, sometimes as low as 3.5%.
Wow, 3.5% is way different from 20%.
Big difference. So don't let the 20% myth stop you from exploring options.
Good to know. Okay, myth number 2. Renting is always cheaper than buying.
Another common one. Also, not necessarily true in the long run.
How so?
Well, renting might have lower monthly outlays sometimes and less responsibility for repairs, but when you own, your payments build equity.
You're building ownership value.
Right. And there could be tax benefits to owning a home, too, like deducting mortgage interest. Plus, rents tend to go up over time, while a fixed-rate mortgage payment stays stable.
So it's a long-term versus short-term calculation.
Exactly. You need to weigh those factors.
Okay, myth number 3. Fixed-rate mortgages are always the better choice.
Not always, no. It depends.
On what?
Again, on your timeline and your risk tolerance.
Sure.
Fixed rates offer stability, which is great for many people.
Sure.
But if you know you're only staying in the house for, say, 5 years, an ARM might start with a significantly lower rate, saving you money during that period.
As long as you're comfortable with the potential for rate changes later, or plan to sell before they adjust much.
Precisely.
Right.
So always better? No. Often a good choice, yes. But ARMs have their place.
Okay, myths busted. Now for some quick-fire questions people often ask. Here's a big one. How much house can I actually afford?
The million-dollar question, sometimes literally.
Ha!
A common rule of thumb lenders use is the 28% rule. Your total housing payment, that PITI, again, shouldn't ideally exceed 28% of your gross monthly income.
Gross, so before taxes.
Correct, but that's just one piece. Lenders also look very closely at your debt-to-income ratio, or DTI.
DTI.
Yeah, that compares all your monthly debt payments, mortgage, car loans, student loans, credit cards, to your gross monthly income. They usually want that total DTI to be below a certain threshold, maybe 43% or so, depending on the loan type.
So they look at the whole financial picture, not just the house payment.
Absolutely. They want to be sure you can handle all your obligations comfortably.
Okay, next question. What's the difference between pre-qualification and pre-approval? You mentioned this earlier.
Right, it's an important distinction. Pre-qualification is usually just a quick estimate.
Based on what you tell them?
Pretty much. You provide basic info about income, debts, assets, and they give you a rough idea of what you might qualify for. It's not verified.
Okay. And pre-approval?
Pre-approval is much more serious. You fill out a full application, provide documentation, pay stubs, bank statements, tax returns. The lender pulls your credit report and actually verifies everything.
So it's a conditional commitment to lend.
Exactly. It's much more reliable and shows sellers you're a serious, vetted buyer. Always go for pre-approval if you're serious about buying.
Got it. Pre-approval is the way to go. Last question in this round. How do I choose between fixed rate and adjustable rate? We touched on this, but any final advice?
It really comes down to those two things again. How long do you plan to be in the home?
Your time frame.
Yes. And second, what's your comfort level with potential payment changes?
Your risk tolerance.
Right. If you're staying long-term and really value predictability, fixed is usually the safer bet. If you're shorter term, maybe moving in 5-7 years, and okay with some rate risk, an ARM could save you money up front.
So personalize the decision. No single right answer.
Definitely not. It has to fit your plan and your comfort zone.
Great answers. Okay, for listeners who are thinking, right, I want to do this, let's map out a basic action plan. What are the steps?
Okay, step 1. Check your credit. Get your credit report, look at your score, dispute any errors, know where you stand.
Crucial first step.
Step 2. Start saving. Seriously saving for that down payment and those closing costs. Figure out how much you'll need and make a plan.
Okay, save, save, save.
Step 3. Get pre-approved for a mortgage. We just talked about why that's so important. Do it early.
Before you even look seriously at houses.
Ideally, yes. Step 4. Find a good real estate agent, someone you trust who knows the local market.
Your guide through the process.
Exactly. Step 5. Then you start house hunting. Knowing your budget, having your pre-approval.
The fun part.
Can be. Step 6. Make an offer when you find the right place. Your agent helps here.
Negotiation might happen.
Often does. And finally, step 7. Complete the closing process, lots of paperwork, final checks, then you get the keys.
Keys in hand. That's a clear roadmap. And what about tools or resources to help along the way?
Oh, lots of helpful stuff out there. Online mortgage calculators are everywhere. Great for estimating payments.
Play around with numbers.
Yeah. Home affordability calculators, too. They help you estimate how much you can borrow based on income and debts.
Good reality check.
Definitely. We mentioned HUD-approved housing counselors, fantastic resource, often free.
Worth looking into.
Absolutely. Real estate websites like Zillow, Redfin, Realtor.com have tons of listings and info. And check for local or state housing programs. Sometimes there's down payment assistance available.
Your tip, look local.
Always worth checking.
So as we wrap up this deep dive, it's really clear buying a home is, well, it's massive. A huge financial step.
It really is.
But with careful planning and really understanding these core ideas we've talked about, PITI, loan types, HELOCs, collateral, it can be a really empowering experience.
Absolutely. Taking the time now to learn about the options, figure what fits your finances, your goals, that's key to moving forward confidently.
It really sets you up for success. So here's a final thought for you, our listener, to chew on. How might getting a solid handle on these mortgage basics now really empower you to build that long-term financial security, to actually reach your own home ownership dreams? What other questions are still bubbling up for you as you think about taking this crucial step? It's about using this knowledge, as a launch pad for making informed choices.